You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live every Friday at 1:30 p.m. Central, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by QuickStrike, options pricing and analysis software. QuickStrike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. QuickStrike has you covered, with market data reports ranging from open interest to the term structure of volatility. QuickStrike is the perfect addition to your trading toolkit. Learn more about QuickStrike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuickStrike1. That's QUIKSTRIKE1. This Week in Futures Options is also brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. That funky tune means it's time for the final program here on our broadcast and recording week on the old Options Insider Radio Network. Some may say the funkiest, certainly the one with the funkiest tune. Yes, it's time for TWIFO, This Week in Futures Options, as the name implies. The program that breaks down all the hot action in the world of futures options this week. What was lighting it up? Was it lean hogs? Was it soybeans? Was it S&P E-minis, WTI, crude, gold? Who knows? We're going to find out in a little bit. And of course, you can always check out all the great archives of this and all the programs on the old Options Insider Radio Network, wherever you find your favorite podcast programs, iTunes, TuneIn, Stitcher, including our website, theoptionsinsider.com, or via our mobile app, available for iOS, Android, and the beloved Fire OS. And I know you guys also, if you're available, you can join us every Friday, 1:30 p.m. Central, 2:30 p.m. Eastern, live via Mixlr, MIXLR. Same link we always put out for VolViews and for OB and everything else. Same link. If you had it before, use it again. And if you are so inclined, you're interested in all things commodities and volatility and action and unusual activity, come join us. We love to hear you guys in there. And however you hit us up after the fact, live streaming from our site from a donkey cart in Uzbekistan, however you get the show, hit us up with your questions. We do love to hear from you guys. And joining me, let's start off right next to me today. I got the rare treat of having him in studio. Usually he beams in. Well, last couple of weeks I've been beaming in from Parts Unknown, but usually he beams in from Parts Unknown. I'm happy to say I'm joined in the studio by my cohort in all things futures options, Mr. Nick Howard, the creator of Quick Strike. Mr. Nick, welcome to the Options Insider Studios.
Hey, good to be on site. Probably be beaming in next week from some part unknown in the central United States. So not quite sure
Not another
yet.
parking lot, I hope.
Maybe not. Maybe an airport.
Oh, even more exciting.
Yeah.
Might be better, though, when I was beaming in from that patio at RMC a couple of weeks ago where there were, birds and sirens and explosions, dump trucks. Yeah, everything going on in the background there. So hopefully you can do a little better than that for us next week. And also joining us, sitting in the CME hot seat this week, he's a newcomer to this program, even though he's been on a bunch of our other shows in the past. You may know him as the Rock Lobster, Mr. Andrew Giovinazzi from OptionPit.com. Mr. G, welcome to your first appearance here on the Big Futures Option Show. Welcome to TWIFO, sir.
I've never been on the last show of the week before. I feel like I've danced around in shows during the week, but I've never danced on the very last show of the week. It feels like Friday to me. But it's exciting to be.
You're moving on up in the world, getting prestigious, sir.
This is big, CME Group. Oh, my gosh.
Getting prestigious. And you're in the CME hot seat, so acquit yourself accordingly, sir. All the hot questions and inquiries will be coming your way. By the way, if you want to follow along with us on the show, of course, you get the live stream at Mixler. If you want to follow along with your own reports, cmegroup.com/TWIFO, TWIFO, or TWIO. That also works. They used to have it as TWIO. And that will bring up the reports that Nick and myself and Andrew are going to be breaking down throughout the show over there on Quick Strike. Let's kick things off. And Andrew, one of the reasons I wanted to have you in the old CME Group hot seat this week is because, quite frankly, I can't remember the last time. We touched on it a bit on OB, touched on it a bit on ball views, but it really, I think, is important to do on this show because Quick Strike, quite frankly, is the only thing that has the tools to really break it down like this, which is why I wanted to do it here. But I can't remember a time we've been doing this network for a decade. I can't remember a time like this where we've been inundated this much with questions about skew in the S&P 500. Everybody and their mother wants to talk about it. You know, we got hit up all week long by our listeners, by our readers, by, media, all the above, all wanting to know what's going on with S&P 500 skew. Now, we talk about this, Nick, you and I talk about this a lot on the show, not in the S&Ps all the time, but in gold and crude and a bunch of other products. They all have their own skew. And but the S&P, the indexes, is kind of the mothership of skew. That's where a lot of people draw a lot of their interest. They draw a lot of their indicators from. We can get to that in a little bit as well, the efficacy of skew as an indicator. But still, kind of interesting. A lot of people were panicking because this time last week into Monday, we saw skew really starting to spike out there in the big S&P 500. And it could be, I don't care, pick your poison. It could be the big ES options, could be the E-minis, any of the S&P 500 flavors. They are all exhibiting this kind of same phenomenon of really, really aggressively high skew. Now, of course, skew on the surface, when you just hear that number tossed out to you, or you just think of the term skew, you think of, particularly in the indexes, the premium of the puts to the calls. That's the way it breaks down. So a lot of people came running to us willy-nilly. Hey, what's going on? Are people really buying this many puts? Why is it happening now versus a month ago? So I'm sure you guys over there in the land of Option Pit, you do a lot of mentoring and education when it comes to equity and index options and volatility. I'm sure this came up. What are your thoughts? First off, give us your thoughts on why you think we saw the setup that we did this past week in skew. It has since come off. We've seen a dramatic maybe retracement of that skew, nowhere near as aggressive as it was about a week ago. So what did you see? What was your take on it? What were your clients and mentees? Were they as concerned or confused about it? And why do you think we saw it develop the way we did over the past week?
Right. Well, I think at the beginning of the week, the easiest way to think about skew, I think, is just it's a function of where where vol is. Where is at the money vol in the S&P 500? So if volatility is pretty low, in general, you're going to have sort of steeper curves, meaning the puts are going to be more expensive, and the calls tend to be, but not totally, a little closer to the money just because of the vagaries of why you have skew in the first place. So we've had such low implied volatility pretty much everywhere, especially we've had low vol at the money. So how the market responds to that is they kind of kick things up a little bit, and especially for puts. So what happens is you start to get things start to get unbalanced from that point. So clients at the beginning of the show, I'm sorry, beginning of the week, for us, we were looking at why are the puts starting to kick up a little bit, and I think part of it was, I think there was a lot of Washington D.C., a lot of politics, but there was also an unwillingness at the beginning of the week to let the at-the-money volatility fly because the realized vol so low. So what happens is volatility, especially in the index products, especially in the big index products like the S&P 500 options, the vol gets in a vice, meaning you can't bid the at-the-money up too much because nothing's moving, yet events on the horizon start to make people want to hedge. So the combination of sort of low at-the-money vol, that will lead to lower out-of-the-money calls. And then they start to bid puts up, and you start to get numbers. Everybody starts freaking out about how wide, the skew is, the call and the call put ratio. When it's, you also have to think of why it's there in the first place. You're starting to, the whole idea of skew is to sort of correct Black-Scholes and all that kind of modeling. So it's a function of the many parts of volatility that exist in the marketplace. So when people are freaking out like that, I say, well, it should price like that. It's supposed to price, those puts should price expensive relative. That also is an opportunity, I think, because it makes gamma near the money really cheap, and you can sell stuff out of the money, and you can get great prices for it. And you can actually set up gamma positive trades with positive theta if you have portfolio margin, or if you know how to use margin, because you can kind of sell out of the money puts versus sort of it's just a more advanced trade, but sort of back spready type near the money stuff, and you're getting kind of paid to do that, put that position on. As far as function of how skew works, I would say this is kind of normal. That position would have paid pretty well this week because we had a bit of a swing, and now things are settling down. I think it's a function of what's going on in Washington, and just low vol. It doesn't take much when volatility is at multi-year lows. You just need a little something to kind of get it moving again. So part of the idea of skew is it prices the next move. It doesn't necessarily price this move or price the move that everybody thinks might happen. So it was certainly I think there was a lot of great headlines, but as usual with volatility, nobody knows where the heck it's coming from in the first place. So that's why you have this show, Mark.
That's indeed why we have this show, and I think that's a good point about the predictive powers, or perhaps lack therein, of skew. I think we'll get to that in a little bit, because that's another thing people are hitting us up about. But Nick, I want to get your thoughts as well. And the reason why, when people started hitting me up all this week about skew, my initial thought was, man, I hope we can hold this till TWIFO on Friday, because this is where I want to break this down. Because this is, I think you create? You can tell me if you didn't, but. Did you create quick skew with this environment in mind? Because this is kind of like the ideal showcase for it, where people are talking about skew in this net aggregate kind of number fashion. But as we've said many times on this show, skew is two moving parts. It's the call wing and the put wing. And we say all the time, a lot of time, particularly in the volatility part of the component of the landscape, you have to have that context in mind. With skew, it is required. It is integral to the notion of what's going on. You have to know what's going on in the calls and the puts. It's kind of, you can't know a fraction if you don't know the denominator and the numerator and the denominator, and that's the case with the call wing and the put wing. So quick skew breaks this kind of stuff down. I know you've been watching over the past week. Have you been freaking out as well? People have been hitting you up over there, and what have you been seeing out here? Let's take the E-minis, because everyone likes the E-minis. Certainly a lot of listeners of this show love the E-minis. What have we been seeing lining up out there in the skew in this thing, and has it been as kind of as wild and woolly as people have been saying?
Yeah, well, first off, I agree with the statement about the low vol and that sort of happening with the smile getting sort of crooked from the puts down to the calls. So that makes some sense. I don't necessarily agree with the freak out so much, and I'll get to that in a second. But I think the reason quick skew was created was, partly to be able to take a look at the numbers and have an idea of what the vol curve actually looked like, right? Because typically you're getting that number. It's either negative or positive, and if it's negative, the puts are more, and if it's positive, the calls are more. At least the way we calculate it, it's call minus the put from a volatility standpoint. But it never really was telling me what the curve looked like. So with the quick skew, you can look at the numbers and you can have an idea what the vol curve is shaped like as well. So, and the idea behind that is, you can go look at the current vol curve, but if you look at a historical quick skew, you can immediately see, the variations and the fluctuations of the vol curve itself without having to actually click into each of those dates and see where what the vol curve looked like. So right away you can tell what the shape of the curve was, what the smile was, whether it was crooked one way or another, and you could also see the relationship of the calls and the puts to the at the money. So that's really sort of the primary reason why it was there. But going back to being freaked out, I mean, when I started to see those articles that you were referencing and the other talk on the shows, I looked back and really the calls and the puts have separated a little bit. The puts got a little bit richer and the calls got a little bit cheaper. So we did see a little bit of an increase in that in those quick skew numbers per se, in that separation between the two 25 delta options. But if you go back and look at it from a historical standpoint, it's really not any worse than it's been over the last 2 or 3 years. I mean, it's been fluctuating around certain levels for an extended period of time, and you could see that in some of the reports out there. But we did see this week where we definitely saw some some put bid and some call offered. Now I'll offer another possible cause for that, and it could be as this market has rallied, that people could be selling calls into the rally, right? To sort of if they're a long portfolio strategy, it could be selling calls to increase their return, and then also protecting on the downside as well. So it's sort of your typical index play, right, where you're willing to give up some of that upside to take advantage by getting on some of the calls from a sales standpoint. So I didn't get too freaked out. The vol is super low. It popped from a percentage standpoint. If we look at the 30-day option as our baseline, it was essentially about 8.5 at the beginning of the week, and it's like 10.6 plus. So that's a pretty good relative percent increase on those levels, and it is so low that you're going to see those kind of moves, I think, pretty much as we move forward here, because it's not going to take much to push it one way or another.
Yeah, that is kind of what we're seeing out here. There's so many different moving parts to this that, that's why, again, listeners, if you're playing along, cmegroup.com/TWIFO. Correct me if I'm wrong, Nick. They can't click the quick skew link, right, on there?
No, but do you want me to elaborate on that? I think what we're going to do, we'll
tease
the users. I think what we're going to do, Mark, is that during the show, if you're listening live, we're going to turn those links on live for that hour of live show, that you'll be able to go dive right into the numbers that we're seeing. So you'll be able to see the historical quick skew, the historical volatility, all those kind of things. So they can't click the links. We are probably going to toy with making that first row clickable, or the row that's most relevant, meaning if it's like under 1 day, we'll probably make it the next item. But in the near term, you will be able to click those links at least during the show, because I think that'll be a fun way to follow along.
That would be awesome. So another incentive to join us live every Friday, 1:30 p.m. Central, 2:30 p.m. Eastern here on TWIFO. Podcast listeners, kind of out of luck. You got to get the full suite of quick strike tools, because if you do, you can do exactly what I'm talking about right now, which is, of course, click on the quick skew link, and you can see for yourself. When you see it in graphical form, and again, this is really why I like to use this tool as opposed to a lot of others, because it shows you in a very clear graphical fashion exactly what's going on in the call wing and the put wing, which you need to kind of put together to make your own determinations on skew. And we can see, as Nick alluded to, that last week some of the the puts were getting juicy, which is one of the first things you assume when you see skew getting up there. But also the calls were getting. I think the technical term is whacked there, Nick. So that combo you can't. That combo makes your skew elevated. When calls are cheaper than they probably normally would be on top of the put buying, that's also going to make your skew disproportionately look aggressive and large. In addition to everything Andrew was saying earlier about we're in this crazy low. We were, at least earlier last week and earlier this week, in this crazy lower volatility environment. Volatility ticking up, a wee bit over the week. A lot of people were also writing in on the timing on this. I don't know, Mr. Rock Lobster. A lot of people wrote in asking us, hey, why would Skew? And we kind of touched on it a little bit, but why would Skew bid up now? And why wouldn't we see a similar development? Let's say a lot of them asked about a month ago. Where we saw going into late February, early March, we had the Fed coming up. We still had a lot of earnings on the horizon. If there was a time to drive Skew up ahead of some anticipated risk, that was certainly it. Why do you think we didn't see it maybe a month ago as well?
I think the problem with a month ago was everybody was still believing in. I think basically almost all the movement now around the S&P 500, at least for the last week, has been all around politics. We've had huge moves in equities, pretty fantastic ones actually since the election. We've had I don't know how many days, over 100 days without a 1% drop. So, it doesn't take, like I said, it doesn't take much to make volatility rise or the curve kick up a little bit. What happened, though, was, before everything was, things were going to happen in the future, and there was a lot of giddiness on the rally. And then, reality hit politics this week. And I think people just pulled back and, everybody wants to be right about the prediction for the next crash. They rush in, they buy puts. And I think this was, I don't think we obviously we didn't crash. We sold off a little bit, but it wasn't enough really to tank the market, but it was enough to bid the downside vol up. But I think because this was the first real test. This was the first real test of, can Congress do something? Can they deliver on taxes and all these reforms that everybody thought was going to happen? And right now the kind of jury's still out, but it's certainly out enough to drive volatility higher, and volatility at the money's going higher, and all those numbers are going up. So what'll happen was, as vol at the money increases, you're going to start to see the curve. Those numbers we saw, a couple days ago will probably start to diminish a little bit until we have some sort of resolution either this weekend or into next week, where everybody just decides they don't care anymore. The sky didn't fall. So I think that's the reason. I think there was a lot of rally on that favorite drug of ours, hopium, and everybody ran out. Their bowl got empty, so they were looking for the cold slap of reality.
Speaking of cold slaps of reality, I like how you set me up there, sir. That's why I like bringing you on these programs. You're doing a good job in the old hot seat there. Even though you're squirming a bit, I can see it, but it's all right. It's an uncomfortable seat designed that way on purpose. I don't call it the hot seat for nothing. Talking about the cold slap of reality, a lot of people also hit us up this week saying, what does this really mean? How is, the traditional reading of the high skew is okay. Everyone and the mother's panicking. Looks like they're worried about tail risk. So they're going to hedge some tail risk event, and then therefore this should be read as imminent aggressive sell-off in the S&P. And we did see a bit of a sell-off, our first 1% move to the downside in the S&P in quite some time, back earlier this week, I believe it was Monday. So maybe that was the initial, that was the harbinger of that move. But aside from that, how predictive is that? And of course, there are myriad other readings of skew as well. People are obviously, if they take the traditional reading, they're buying puts, but they're still kind of along the market. So they're staying hedged, they're staying in as opposed to getting out altogether, which is maybe another contrarian reading of it. But some interesting data, I was looking at this coming out, I think it was Pension Partners. Everyone, again, and their mother talking skew this week, including these guys doing some data over there at Pension Partners, looking at the actual numbers. They crunched the actual numbers of how effective of a predictor skew actually is. And they found that in these moments, like everyone, the sky is falling, Chicken Little moments like we had last Friday into Monday and early this week when the skew was at record highs. What are those moments? What do they really predict? Do they predict big tail risk moves? And they found that total all those top 5% moves, actually not so much. They didn't predict, actually predict a little bit worse. Then they compared them to, again, all skew levels, which is a little bit of a misleading comparison, but still didn't do anything different. And in terms of also looking at it versus the downside moves, still wasn't as good of a predictor. In fact, actual tail risk, you're looking at when skew was at its highest, how did it predict greater than, 1%? In every period, the worst declines in the market that followed high skew levels. So that's what they looked at. They're actually much lower then the worst declines that followed low skew levels. A little counterintuitive. Bear with me. We'll put some of the links and the pictures in the article so you can see it for yourself. But that said, when the premium for the puts was that aggressive, the skew actually, as an indicator, the net S&P 500 skew actually underperformed, and actually the bottom 5% was actually had larger tail risk events coming in on that. I don't know, Mr. Andrew, does that surprise you at all? That skew maybe a little bit overblown in terms of its prognostic capability?
Well, I think it's a function just of where the market is at any particular time. You know, it tends to flatten when vol gets high, and then when vol gets high, everybody freaks out and the market gets lower. So it's a very from a concept point of view, I think it's always interesting to look at, but it doesn't surprise me hugely just because of the nature of how the product works. As vol gets higher, the curve generally gets a little flatter. And vol gets higher, the market goes down. The vol gets higher, and the curve gets flatter. So it's I think just not kind of understanding how things actually work like that. But it does sound good in articles.
Makes for good headlines. That's true.
It does, and it gives us great fodder for the show.
Yes, which we're always very thankful for. Mr. Nick, I could see you typing furiously away over there. Nice to have you in the studio. I can see exactly what you're up to at all times. I could see you have some thoughts on this. What do you think on all these things we're talking about? You know, the evolution of the skew, the perhaps dubious predictive power, a lot of other things. What's your take here?
Yeah, I would tend to think that it's probably when it's set up to look like it's such a big deal, like with the puts are so big, and I think that's just the market, playing out the way. The way that market trades, right? So we're not seeing much of a difference here with the puts and the calls, right? We talked a little bit about how, there's certain things that take place in at least the index market as well, where people are financing portfolios by selling the upside, and they're protecting their portfolios by buying the downside. So we're going to have this natural look and shape, and as Andrew said, we're going to, that shape's going to fluctuate around the at the money based on the level of the volatility. So, as being predictive, then if that were the case, then the S&P should always be breaking more than 1% based on the way the curve looks like, and it doesn't do that, right? So I think the most predictive I think we've seen since we've been doing the show is when Brexit was in place, right? We saw the pound puts were really, really bid, and we actually had a move that was commensurate with that volatility that was out there. But, I think, when it's... the surprises are what cause problems, right? If we were in a state of irrational exuberance with this upside, and the puts were flat to that, the monies are just a little bit expensive in comparison to the calls, then that's when I think it might be even more predictive, right? That's what how I tend to look at it. When we have a real smile or a flattened smile, that's when I think you start to really start to maybe have an idea what the market's going to do, because it could go either way at that point, right? Then it's like buying a straddle. You're going to go up or down based on the way the curve looks. But I think from the S&P standpoint, I don't think we're really seeing anything like Andrew said, and like you said, I think it's good fodder. But I read the first article you sent me, and I was like, this article doesn't make any sense based on what he was saying. It was just a lot of words getting thrown around. This article was a little bit better, but I like seeing this result of, hey, skews at this high level. Where do we go? And it's not surprising to me either that we didn't really make the big push down, because market's set up for a big push down. Therefore, you're going to get some natural resistance in that direction anyway. So anyway, we'll see. We'll watch, right? Until the skew in this S&P changes considerably, I don't think things are much different than they have been.
There you go, poo-pooing all things skew there, Nick. But I want this is a good opportunity. People are always writing into us on this show saying, "Hey, can we talk a little bit of the indexes? Can we talk a little equities indexes on this show?" So we don't get a chance to squeeze them in very often. This seemed like a perfect opportunity, particularly with so much focus on the skew. If you're going to break it down, quick skew is a tool to break it down. So it seemed like a perfect fit for this. So all you guys out there hitting us up saying, "Talk more equities on Twifo," there you go. you got your equity stock. I even brought in the rock lobster for you to do just that. So you can thank me for that. Of course, we got to touch on the other big boy out there in the commodity landscape yet again this week, dominating a lot of the headlines. It is, of course, Texas tea, black tar, call it what you will. Of course, WTI lighting it up again, this time to the downside. Futures net on the week off about 2%, about a handle or so, depending on where you look over there in the term structure. Again, we're shy of that magical, mystical 50 handle. And so as a result, we did see a little bit of some vol actually coming in, Mr. Nick, or coming up, I should say, which was, again, you're going to see a little bit of that sell-off. You're going to see that happening. It's not quite the explosion of vol we saw a few weeks ago when the sell-off first started out there in crude land. That's when we saw that huge spike. And listeners, you guys have been writing in for a while saying, hey, what was it going to take? What was it going to take to really budge WTI volatility? And we kept saying a sharp move to the downside. That's exactly what we saw. And of course, that sharp move didn't really continue. So the vol came in again. Now this week coming up a little bit again as the sell-off kicked off a little bit again this week. Overall, a fairly active week, not the most active week. Open interest up about 4.5% out there. Again, vol ticking up, futures selling off a wee bit. And then once again, if you're asking us where the action was, once again, predominantly front month, it was nearly half of the paper, about 47% coming in that May contract with about 324,000 contracts. And if you're asking us, hey, what was number one with a bullet? It wasn't in the front month, though, this time, Nick. And the quick skew, or I should say, quick strike, playing games with us sometimes. They're throwing us for a loop. It was actually a little bit farther out in, what is that? That's the July contract with 16% going up out there. Only 16%, but the number one with the bullet, and this probably was maybe surprising to you as well, Nick. It certainly was surprising to me. It wasn't the 50 calls. It wasn't even like a 45 put or something in that range, which certainly were popular in other months. It was the 57 calls in July that were lighting it up, and it was pretty much today. It was all that paper was today. 32,000 and change. Actually, total of 35,000 on the week. 34 of that coming today. So aggressive opening paper out there in July, which is kind of funny. Looks like it might have been a vertical here because there was 32,000 of the 52. So maybe a little bit of a 52, 57 vertical going up out there in July. Again, the lion's share, all of that going up today. It looks like maybe a little bit of a ratio on the 57s there because a little bit more looks like about 3,000 more of those went up total on those on the 57s versus 52. So if you had asked me today, what is a far upside vertical, that would have been the number one trade out there in WTI. I probably would have said no, but go figure. The surprises keep on coming. And then number three, with less of a bullet, was these 50 calls out here in these are in May, with about 24,000 of those bad boys lighting it up this week. Pretty even with about 7,000 and change coming on Wednesday, followed of course by the 45 puts. These are the strikes we expect, Nick. We expect 50 calls to light it up when we break to the 50 strike. We expect 45 puts to light it up when we break to the 50 strike. We did see that, a lot of action on the 45 puts as well, about 20,000 and change, putting them in the number 4 or so slot. I'd be remiss if I didn't point out a little bit of some longer-term, quasi-longer-term paper as well. We did see some love, a little bit less love, not 20,000, but about 5,000 contracts, Nick, of the D60s also lighting it up this week as well. Pretty even throughout the entire week, actually, was kind of interesting, about nearly 6,000 of those going up. So some interesting paper pretty much across the board out here. What, amidst this sea of activity, Mr. Nick, really caught your eye this week?
Well, one thing you could take a look at with the TWIO report is that when you click on that volume link in the most active columns, you'll see 3 bars in today's column. There's a blue bar, a gold bar, and a purple bar, and that's going to tell you where the trades took place. So today, if you look at the purple bars, those are the block trades. That 52, 57 traded on the, it was an equal amount between the 52 and the 57 call. So that was a vertical, like you said. So it got reported as a buy 52, a sell a 57, but a block gets crossed, so somebody's doing it both ways, right? So it doesn't make a difference. So it'll be, we'll have to watch and see what the openings were or what the closings were on that strike. But it's definitely a roll, somebody thinking one way versus another. So that was a lot going on there. From that's why we look at the block, because a lot of the times when you see those big numbers, the majority of that volume is coming. It's off market. It's two counterparties are crossing that trade. As far as noticing anything different, you did a great job with the volume and the open interest. Again, not one of our bigger weeks from an open interest standpoint, just like 4% overall for the product itself. But still, again, another upside week on the open interest. I'm going to pull up the weeklies here real quickly so we could see what those did, see if it's any better, because the CME's been pushing the weeklies now, trying to, we talk about it all the time. Why aren't these things trading? Especially when you can get from 6, 14, 20 and 6, 14 and 20 day exposure with the weeklies. So that's going to happen. It's going to come quickly, but not a lot going on in here this week either. But one thing I wanted to point out after last week, right? We talked about how the vol curve, when we had that big move a couple weeks ago, how the vol curve flattened, right? We saw May and June were a little bit cheap to the rest of the term structure, and then the vol pumped, and as you would expect, Andrew, those front months, the gamma months, right? They're going to catch up because people are going to try to get out of the activity. So it flattened up, but we saw that that term structure came right back to where it was before and closed itself down, and now we have it looking the same the way it did before the big move, where the front 2 months are much is the wrong term, are lower, from 4 to 2 to 4 vol lower than the next contract, which is the July contract. But what I did take a look, if you're looking at the term structure on crude, and this is what I find interesting, and I think here's where there's some trade here. The next OPEC meeting's not till June 4th, and the June contract expires, I think, around May 17th. So the July contract is the highest volatility bid on that term structure, because that is the first contract that will encompass the OPEC meeting, and then everything trails off after that. So when I see that kind of stuff, I tend to like to look at some sort of vol spread that's going to sell that higher volatility and cover myself with. I may not go with the June, but I might do a June, July, August butterfly, where I get on that heavy vol and cover myself up a little bit, because we're going to have a run up. It's going to be not just on the OPEC day. It's going to be just prior to that. So June might not be enough, but that August contract probably will. Or maybe this is where you start looking at the term structure and including the weekly volatilities as part of that term structure, so you can then do a better job of seeing, maybe you can buy some weeklies and sell some July contracts around that, or roll the weeklies to cover yourself as we go forward. So that was sort of the interesting thing. And the weekly vols are cheap in comparison to the rest of the stuff. So maybe as we start moving forward, you can take a look at trying to cover some of the vols that you sold in the July contract with some of the stuff that's coming on as part of the weekly expirations that are available. So that's the big thing noticing this week, that the term structure sort of went back to pre-big move shape, and that the July looks a little bit out of whack in comparison, but that out of whack is based on the OPEC meeting.
Old school term structure rearing its ugly head again out there. How long do we talk about that for? Pretty much the better part of a while out there in WTI and coming back. Mr. Andrew over there on the CME hot seat. I know you trade a lot of different and disparate products out there in the commodity side. I know you hit a lot of the ETFs, but I know you watch WTI and some of the big ones, and of course the OIVs that are derived from it with their volatility and things. And I'm sure your crew of chatties and mentees are pretty active on that side of the fence as well. People always look for where the vol is, and of late, crude has been delivering. What's your take on what we've been seeing out there in crude lately, and the developments in volatility and skew and everything else that we were just breaking down?
I think the biggest one is most of our bigger clients. They like the juice in WTI, mostly like 1x2 put spreads. Stuff like that, buy one, sell two, trying to, basically fade the lower prices in oil. That has been the most popular trade for the mentees and some of our other, I would say, just bigger traders for a while, because oil's just been kind of stuck around 50, 52, 54. It's not doing, very much. We had kind of that just slide recently, but that has been the stuff that is lighting, let's just say it's lighting their candles, so to speak. Not their oil file candles, but that's the trade that has got the most activity. And I think you look at a lot of the open interest, you probably see some of that you could see a little bit of activity, coming that way. So that has been the big thing, at least for our clients, what they're looking at. Not so much buying calls, not a lot of interest in that. Just sort of give me a little juice and put it out of the money, and then I'll kind of quietly sneak away. So
that wasn't them buying 32,000 of the 52, 57 vertical out there in what was that, July? That wasn't your clients.
It is not. No, nobody's seeing that big the big jump in the on the horizon. Could happen, but mostly it's been sort of the downside ratio put spreads and stuff like that. That there's good juice in WTI, so that gets people like their juice.
Yeah,
to sell.
Yeah, looking at the open interest on those two strikes, they're both below 1,000, so those are opens pretty much. So somebody's making an open play, and I would agree. I think if I'm going to buy any calls, it's going to be closer to the 50 handle than 50 strike than it is to the. So it's a good way financing with the 57 to buy the 52. Seems like a decent way to get on.
Nick, you're saying that was you, 32,000. That was you.
I did a block of 32,000.
Small size for you, I know.
Yeah,
but,
it's not. Premium wasn't too bad. It's July.
It was your play money.
Yeah, that 90-day option, that's going to be fairly expensive, I think, right there. But that's probably, I would imagine that's what's going on, because we haven't seen, like you said, we haven't seen anything tick much up past 55, and that's really where people have been wanting it to go, and it hasn't been able to go up there. So now you basically get, $3 till you get to the 55 from the 52, and you still got 2 to go with protection and that kind of thing, and that call spread's in good shape if you're owning that, and who knows, they may very well be financing it with some sale on the downside, since we haven't really breached that 45 strike either. So again, we'll take a look tonight after 11 p.m. Central, and those open interest numbers will be updated, and you'll be able to see what the 52 and 57 strike did with that big block trade, and of course twice as many traded, right? So half of it traded in a block, and then the rest were, electronic.
There you go. Good insight, sir. Let's keep on rolling. It's time for you guys to join us on the program and bring in some of your questions. It's time for your futures options feedback.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options, facebook.com/theoptionsinsider, stocktwits.com/optionsinsider, or via questions@theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live every Friday at 3 p.m. Central via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's MIXLR.com.
All right, everybody, welcome to the Futures Options Feedback. This is the portion of your show where you ask all your questions to Andrew, and Nick and I take a break. No, this is, of course, the portion where we answer all your questions. This guy, Milk, I answered that last week, I believe. This guy, I think you tweeted this, but I don't think we had a chance to touch about it on the show last week, Nick. This one's been sitting around for a while, but it's an interesting one. This is Alv13. He says, what the heck makes crude sweet? Slightly off topic, but it's always bothered me. As I recall, Mr. Nick, this has to do with the sulfur content of the crude itself, and it's in the refining process, because crude naturally has a lot of sulfur content, as you know. Sulfur doesn't smell very good. In the refining process, they pull a lot of that out. Hence, it smells a little sweeter. Is that reductive, Mr. Nick, or is that how you kind of see it as well?
Yeah, well, mine is purely internet information based. Yeah, so the lower sulfur level gives a sweet taste and a pleasant smell, whereas a lot of petroleum contains higher levels of sulfur, and that's going to give you the sour taste and smell, or the pit smell, you might call it, right? Where we're in the good old days, like you're used to after a hump week night in the pit. So so low sulfur, sweet. High sulfur, not so good, right? It's like that candy commercial What is that? First they're sour, then they're sweet.
Oh, I missed the candy commercial about low sulfur candy.
No.
That would be a good ad.
That would be.
Keep the sulfur out of your candy.
Hey, as just a quick aside, and it's sort of kind of related to the crude oil, but my dad and mom always talked about when they were kids, they used to chew the tar, which obviously was made some byproduct. They chewed the tar off the street when they were kids instead of having gum. Believe they grew up in Chicago. That's what they did.
That sounds.
So
that sounds
I think
horrible.
it was prior to the petroleum being in it. So
I guess hopefully they had the sweet version at least. It wasn't as sulfurous.
I think a lot of them did it. I hear that story over and over
chewing
again.
the tar.
Yeah.
I've literally never heard that before. You're blowing my mind here in the studio. Before you keep blowing my mind. You got anything on sweet crude, Mr. Rock Lobster? You want to move on to the next one?
I mean, it's easier to refine, I think, too, getting the sulfur out. But is that the version of I walked 20 blocks in the snow? It's like I just used to eat the street. My gum was so tough.
I'm telling you, I'm not even kidding. My dad and mom have talked about that numerous times, that they would just pick the tar up and chew on the tar, and they get black, their black lips and tongue and stuff like that. But I think it was because it's now what's in it, it'll kill you, I think. But back then, I think that's what they did. Hey, they grew up in Lincoln Park, Chicago. They had a pretty good
rough times.
Pretty good.
It was
man.
during that well-known gum shortage of the 50s and early 60s.
They had money shortage. They didn't have a gum shortage.
Wow, literally chew the tar. I've never even heard that as an expression. So you're blowing my mind here, listeners. Write in if you too experienced the horrible gum shortage of Chicago in the mid 20th century. Let's quickly pivot away before I crack up some more here. You're killing me, Nick. All right, let's go on this one. This is a good one. You like this one, Mr. Rock Lobster. This is from Henry. Oh, Henry VIII. I didn't know historical monarchs were tuning into our program. Good to know they're keeping up on the latest in all things futures options activity. His Highness wants to know seventh. You're. I just immediately assumed it was 8th. I'm going to assume he wanted to have 8th. Henry VII is nowhere near as interesting as Henry VIII. All right, how closely related are the fundamentals of ES and so the big S&P futures options and S&P mini options? How close are they linked to things like other S&P products like SPY and SPX? Are the volatility, skews, open interest, and the rest always very similar, or do they sometimes trade as their own products? So I spent a lot of time in the S&P pit over on the SIBO, so I have my own view on this. Mr. Rock Lobster, you were on a bunch of different exchanges. So why don't you, I think you spent some time obviously on the SIBO as well. What's your talk on, and maybe I spent a little bit of time on the CME. I'm not sure if you ever did over there as well in like the big, didn't have the E-minis yet then, but they had, the big S&P options then. What's your opinion on the various flavors of these products and how they move with lockstep or perhaps don't?
I just, you remember there's the S&P, the pits are circled by clerks with taking future orders. I mean, S&P 500 future orders, and something traded on the Merc, and you would know immediately on another floor. So all of that stuff, I think all that stuff is arbed and dialed into the micro penny at this point. But so if something moves in the E-mini, it's going to move something everywhere else. It is all connected in the matrix. I don't know which pill you take, but it is definitely all connected. So nobody's selling, let's say you're selling 200,000 ES calls, which is a gigantic order. That trade and that liquidity will spill into everything else quite rapidly, I would add. So they're all connected. Futures too. Throw the futures in there as well.
Yeah, I think the days of these things being these kind of independent silos were gone. They were gone even by the time I came out to Chicago and started trading these things in the late 90s. And even then, I mean, it was a slower form version of what they term HFT. Now it happens a lot faster now, but back then, like you mentioned, you'd have traders in the S&P pit on the CME, traders in the S&P pit on the SIBO, and they'd have headset clerks, and they would arb back and forth what was going on in the various products. So if someone was coming in and selling calls in 1 month in one product, people will start inevitably quoting the other side of that in the other pit and vice versa. And it was sometimes a bit of a delayed reaction. Sometimes it would take maybe a few hours for it to catch up. Sometimes if it was kind of a niggling thing, maybe a day or two. Sometimes for the skews to start lining up and things like that. If it was very aberrant, it would happen very quickly. But now you're right, Mr. Rock Lobster. Everything's computerized. That stuff happens so much faster. So the notion that, let's say, I don't know, you could dive into the E-minis or something like that, and it would be completely unrelated to the skew of the other S&P 500 products. It just just doesn't happen anymore. Those models are so dialed in now. If there is any aberration, it doesn't even take the hours or minutes that it used to take to correct itself. Now it's literally seconds. So the old days of being able to mine that arb for gold, I think, unless you got a massive rack of servers and hundreds of millions or billions of dollars to pour into your tech budget, kind of hard to chase that anymore. Mr. Nick, what are your thoughts here?
Yeah, I would probably tend to agree. I'm sure it exists fractionally, if it exists at all. I mean, for a very short period of time. But I'll take a closer look here. But I'm just looking at the open interest of the contracts, the minis versus the big contracts, and it's kind of, at least at the two that I looked at, that they look like the notional was matching, right? So the open interest in one was times the notional versus the open interest in the smaller one times the notional was almost like they were tied together pretty good. So if somebody's buying one and selling the other, it could match up from an OI standpoint here. But I at this point, in the old days, maybe when it was just the telephones, maybe there was an opportunity there. But then again, the minis weren't around, right? So and that's what the whole SPX and S&P was prior to that, right? You had pits that were in both places, and like Andrew said, you were on the phone and you were talking. So you might have gotten away with it then, but not now, I don't think. But I think I willing to bet, and I didn't look here, and I don't pay attention too much because I watch mostly the minis because that's the market, that's what's driving the volatility, that's what's driving the volume. But those vol curves got to look real similar as well. Otherwise, you would get the ARB for sure.
Yeah, it's kind of hard. The old days of one little independent sideload thing, and you guys had it all kind of intrapid over there in the euro dollars. That was a whole different beast. Maybe we'll get to that one of these days. All right, let's wrap it up here with a question from Burton. Maybe LeVar Burton. Maybe he's writing in. Maybe Geordie of Star Trek fame and Reading Rainbow. He or perhaps she wants to know. I feel your pain here, Burton. He says, "Man, these I'm going to think futures option symbols are killing me. Z for Dees. Why don't they just start from A and go alphabetically through the months? I can never remember these things. Any tips for a new convert?" Well, this is a bit of a stumbling block for a lot of people, particularly people, Nick, who are maybe listening to this show, who are coming in used to trading, let's say, I don't know, Apple options or some of that kind of stuff, not used to trading primarily equity options, and now they're starting to get interested, like a lot of people are getting interested in crude, they're getting interested in gold, and they're coming over to the dark side of the big futures options, and all of a sudden they're confronted with effectively a whole new symbology, which is really kind of, I think they have a hard enough time wrapping their heads around, a ticker symbol for, like, say, an Apple call. Now they got to come in, they got to learn month codes, they got to learn all this other stuff like that. And you've been knee deep in these weeds forever, Nick. So it probably is like second nature to you now. But what do you have to say to someone like Burton, who's coming to it new and fresh, and they're kind of befuddled? What advice do you have for them?
Well, I think, one thing I'll say is he says, why don't they start at A? Well, if you look at them, they are alphabetical, so they're going to only go up, right? So that's the first thing. There are no vowels, so those things are getting kicked out of there as well. And then you just got to, if you know that January's F, and you just have to, know that the next two are going to be in sequence, and there are some consonants that are skipped, but the best way to do it is, we made the symbols with our fingers and talked about it for so long. It was hard at first, but you'll get it. And you got to find it. The best thing to do is go out there, and if you're new to Quick Strike, go out on the free version of Quick Strike Essentials, and you'll see, click on any of the quick EDU sections, and it'll show you right away what all that information is, and you don't even have to think about it. It'll tell you what the expiration is and what the underlying contract is as well. So it's less to think about then.
Mr. Rock Lobster, what are your thoughts on the dense symbology and the futures options side of the camp?
Well, you got a lot of stuff expiring. So that's the vagaries of future options. You got to learn those products. So you go to the CME website and download anything they got. That'll help you paste them like I do to your wall, so you don't paste those calendars up when things expire, so you don't forget. I was just thinking back to the Quotron days. I was actually, my fingers, I had a little reflex action from when I was a quote operator almost 30 years ago. So I think maybe they started there because, maybe the strikes were higher and the months were lower. I remember on the Quotron, because the keyboards are set up sort of A through F. They had five letters of the alphabet on the left and the numbers on the right. I think A through F. So I think part of it might have been just, the Quotron was set up goofy or something like that. So it could have been that's why it's like that, and I'm sure it's too late to change at this point. I can't imagine all of the firms having to change the symbology. I think that would make nobody happy. Nobody.
Nobody except perhaps our friend Burton here.
No, it wouldn't be good. No, the other thing, there's not. I would recommend this. Is the one I will recommend. Go out to Essentials and look at the expiration calendar, and we show the current expirations that are available for all the products, and you can go print it out in a PDF and have it available. So if you go quick EDU and then look at the contract specs, and then there's an expirations tab, you can get all that information, Burton, and then you won't have to think about it so much.
I like that idea.
I also like that music. When that music kicks in, that means we've come to the close of yet another epic journey through the world of futures options. Got to explore some interesting stuff this show. We don't always get a chance to delve into the equities and all things volatility and things going on in the indexes. So I'm glad we got a chance to do just that. Also got out, of course, into the old Texas tea, explore what's going on out there. Always some rumblings out there these days. Always good for some interesting upside trades out there in all things WTI this weekend. And got all your questions across the board. Fluid milk, sulfur, symbology, what do we cover? Everything. Correlation, it's all there. You guys bring us all over the place. We love your questions. Keep them coming. And before we go, as our guest, you get pride of place, Mr. Rock Lobster, holding down the CME hot seat. Well done this week. What is cooking in your neck of the woods? If people listening to the show are interested, they say, I want to learn more about what this fellow is up to. Where should they go? What should they do?
You go to optionpit.com. We have mentoring, daily chat. We teach people how to select, how to trade, how to price based on volatility. So maybe that's why Mark had me on the show. We will be doing a 10-part series on selling premium in a hedged way. So you sell your premium, then you hedge it. That will be our new master class coming up in April, right after Easter. So go to optionpit.com. You will see it in events shortly.
There you go, optionpit.com/events to learn more. Mr. Nick, we kind of teased it at the top of the show, but you guys are thinking about putting in some cool functionality for the live listeners, which we like here. So if you're going to be tuning in live, if you can't make it, we know not everyone's schedules allow it, but if you can make it, you want to tune in live, and you want to have that report up live on the CME website, Mr. Nick, what can they do coming soon?
Yeah, I think we got spring break vacation in the office right now, a lot of people, so it won't be out for a couple, 3 weeks probably, but we'll make it so you go over to the cmegroup.com/Twio, and those, the links, the top links in all the columns will be open, so you'll be able to pull up the charts, the history, the quick skew, the open interest. It'll be real easy to sort of dive into what we talk about here on a regular basis. The other thing to take a look at is just go over to cmegroup.com/quickstrike. That's QUIKSTRIKE. Some of the stuff we talked about today, the open interest tool is out there. There's also a vol term structure tool out there, so you could take a look and see what we were referring to when we talked about the July having a little hump in it in comparison to the other expirations. And then if you're trading, take a look at CME Direct. We have a pretty good integration with Quick Strike now. It's pretty exciting, and coming in the next release in April, you're going to see where you're going to be able to talk back and forth between Quick Strike and CME Direct via the new CME Chat product as well. So stay tuned for some other stuff coming out there. New what's the word I'm looking for? FedWatch tools coming. That's going to be out there in a few weeks as well. So stay tuned, and we'll keep you posted.
Good thing it's not a video show here, because I'm just rocking out to this tune here while the show's wrapping up. And on behalf of Mr. Nick and our guest, Mr. Andrew, and indeed myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show. And, of course, for joining us live. And as you heard, some maybe new bells and whistles coming for you live listeners. So if you can make it, check it out. It's pretty fun. And we'll see you next time for more of This Week in Futures Options.
This Week in Futures Options is brought to you by Quick Strike, options pricing and analysis software. Quick Strike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. Quick Strike has you covered. With market data reports ranging from open interest to the term structure of volatility, Quick Strike is the perfect addition to your trading toolkit. Learn more about Quick Strike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuickStrike1. That's QUIKSTRIKE1.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.